Hey everyone, welcome. We are Probita Training. I will be your host. My name is Tristan White. This is our session on the corporate or company tax rate change and the impact on current and deferred tax calculations. So our agenda, we're going to look at it from four aspects. We're going to warm you up with a bit of an introduction. So look at how we arrived at today's conversation. Then we'll move into a discussion and an example around current tax, and then similarly with deferred tax. And then we'll just remind you in terms of what the impact is on the financial statements or the disclosures that they need to flow from incorporating a tax rate change. So to kick us off, we need to go back in time a little bit to the budget speech. And so that's what brought about today's conversation. So in the 2021 budget speech, it was initially announced that the corporate income tax rate, so the tax rate that applies to companies, would undergo a change. And so that was reiterated during the 2022 budget speech. And so effectively, the corporate tax rate changes from 28%, which we've been using for the majority of the last decade or two. And that change is to bring it down to 27%. And it then becomes effective for companies that have years of assessment, so tax years of assessment that end on the 31st of March 2023 or later. So basically, if we have clients that have a 28 February year end, it puts you in a position where you now need to ask, in a 28 Feb 2023 year end, which tax rate am I supposed to use? Will it be the 28 or the 27%? And so how we approach the answer to that question is going to differ in relation to current tax versus deferred tax, because current tax looks at a year at hand, whereas deferred tax is future looking. And so we need to then appreciate what the impact is of this change and what rate we apply in either of those contexts. So looking at current tax and starting out in the International Financial Reporting Standards, or otherwise IFRS for SMEs. And so what we're going to look at first and foremost is what are the recognition and measurement rules that pertain to current tax? And then we'll bring back into the conversation the budget speech informing us about the change in tax rate. So here we have the two references to current tax and how it's to be measured in terms of IFRS for SMEs, and then IAS 12 for your full IFRS clients, or if you've got a full IFRS set of financial statements that you are trying to prepare. And so kicking us off, in terms of current tax specifically, an entity needs to recognize its current tax liability based on the tax profit for the current year. So that's the recognition rule. Then we move into the measurement rule. Now, all of these rules you'll find in these respective paragraphs that we've listed over here. So an entity is to then measure their current tax liability or otherwise asset based on two things. First of all, at the amount that it expects to pay or otherwise recover using the tax rates that are enacted or substantively enacted by the reporting date. So when I'm trying to measure my current tax liability, I need to consider what is the tax rate that is applicable based on enactment or otherwise substantive enactment at that particular reporting date. And so when we look at an example, we'll try and flesh out these concepts a little bit more. On the other hand, we have deferred tax, and the references to legislation or to the standards are as follows. So IFRS's reference is IAS 12, paragraph 47, SMEs, it's paragraph 29.27. So how do we go about measuring our deferred tax, either asset or liability? It's based on two things. First of all, what is the tax rate that we are expecting to apply to that period when the asset is realized or the liability is settled? Now, again, bear in mind that deferred tax is future looking. And so we need to ask ourselves, in what future period do we expect this particular asset or this temporary difference, or the asset that's related to the temporary difference, when do we think that it is actually going to realize, or otherwise, if it's a liability, be settled? And so what does that mean? It means, in what future period do we expect that item's effect to go through a current tax calc in a future period? So that's essentially what we're talking about when we say asset realized or liability settled. When do we think it's going to run through or go through a future tax calculation? And so that is the period, or those are the periods we need to think about what tax rate will apply in that future period. Okay, so to just bring it back together, deferred tax asset and liability is measured at the tax rates that are expected to apply to the period when that asset is going to realize or liability settled. So in other words, the item that we are calculating deferred tax for, when is it going to go through the future current tax calculation? And then we go and we base it on the tax rates that have been enacted or substantively enacted by the end of the reporting period. So to start us out, let's look at current tax and just set the scene for a second. So when it comes to a company, what is the framework or the breakdown of its tax calculation. And so typically it starts with your gross income. This is basically how the Income Tax Act of South Africa is set out. So we've got gross income, exemptions, allowances, amongst other things. And then eventually we arrive here at taxable income. So once we've run the numbers, put through our income, put through our exemptions, put through our deductions, our capital gains, etc., we arrive at taxable income. Now, essentially what we're going to have to do with that is we're going to have to multiply it by an appropriate tax rate. And that will then give us our tax liability or receivable. So the key question for us is, if we've got our taxable income, we need to determine a rate to multiply it by. And so based on the references that we've just looked at that come from IFRS and IFRS for SMEs, the go-to rate is the rate that's based on substantive enactment. So whatever the tax rate is that is substantively enacted by the current reporting date. So our current year end, which one is enacted, what rate is substantively enacted, that is the rate that we are going to think about using. So before we get into the example, we're going to basically break it down into a bit of a methodology. So there basically are two questions that you need to ask yourself when trying to determine what the most appropriate rate is to use when you're calculating your current tax liability. So you've run the numbers, you've arrived at taxable income, and now you're thinking about a rate to multiply by for the company client. So the first question we need to ask is, what tax rate is substantively enacted by year end? So we need to ask ourselves, what year end point am I at the moment? And what are the available tax rates? So do I have options? And so when we go into the example, we'll use specific dates and then we'll try and understand this. So I need to ask myself, what is the rate that's substantively enacted by year end? That simply means, do I have options? So there would have been a former rate, and now there is potentially a substantively enacted rate. So do I have options? What tax rate is substantively enacted? Then we move to the second question, which asks what tax rates applies when that current tax liability or asset is to be basically settled. So at that year end point, when I actually have to make payment, settle, pay my current tax liability, what is the tax rate that applies at that point in time? So to help us visualize, let's look at an example. So we have an entity which operates in a jurisdiction where a change in tax rate from 28 to 27% was announced on the 23rd of February 2022 and will apply to tax years of assessment commencing on or after 1 April 2022. So if we think about our context in South Africa, we had our budget speech on the 23rd of February 2022, and that's where we saw that it was reiterated that the tax rate for corporates is going to change. And it applies to companies that have a tax year of assessment of 31 March 2023, or in other words, tax years that start on or after 1 April 2022. So the key date that we should bear in mind is 31 March 2023. That will be the first year that, or that will be the first year end that the 27% tax rate becomes available or applicable, if I could put it like that. So in our case, our entity client has a 28 February year end, and at a given year end, specifically 2022, the entity has a taxable income of 10,000 Rand. So you've run the numbers, you've arrived at your taxable income, you're now looking for a rate to multiply it by. So our requirement is as follows. First of all, what tax rate applies to current tax at the year end 2022, 2023, and 2024? And what about provisional tax? What rate are we supposed to use when we are doing that determination? All right. So we know in terms of how we measure our current tax liability or our current tax asset, we know that we have to apply the tax rate that is substantively enacted by the reporting date. So let's establish a couple of things. What is my reporting date? So my reporting date is 28 February 2022. And the rule per IFRS and IFRS for SME says, what is the tax rate that is substantively enacted by that reporting year end date? So if we look at our timeline, we'll start out with 23 Feb 2022. That is when the announcement happened of the tax rate changing from 28 to 27%. Then our next key date is our year end, which is 28 Feb 2022. And then the next key dates that we have is that from 1 April of 2022, the new tax rate kicks in of 27%, meaning that the first year into which it becomes effective or applicable is then going to be 31 March. So I'll just slot in our client's next year end, which is 28 Feb 2023. And the first year that this new tax rate becomes effective would be for a year end of 31 March 2023. So this is pretty much our timeline of events. Okay, so I'm going to say second year end, and then 27% becomes effective. All right, so using that methodology that we've just looked at on the previous slide, the first question we ask is, what tax rate is substantively enacted by year end? So question one. So the tax rate that's substantively enacted by year end, we first of all need to understand, what does substantive enactment look like? So substantive enactment basically looks like, has somebody either published something in some kind of law? Have they maybe otherwise announced something? And so substantive enactment basically means, is there some indicator that there is going to be a potential for a tax rate change? And so it can come in the form of an announcement. It can come in the form of a formally published policy in a document or a piece of law. So in this case, what is our indicator that there's a potential for tax rate change? It is the fact that there is an announcement. So the announcement is going to tell us that there is the potential for a tax rate change. So substantive enactment versus actual enactment means the following. Substantive enactment means that it is just as good as it being published in law. So in other words, we don't have to wait for it to actually be published in law for the fact that the tax rate is going to change from 31 March 2023. We don't have to wait for it to be published in law for it to become believable and accepted. The announcement is just as good as it formally being published into law, that the tax rate will change from 28% to 27% for year ends 31 March 2023 or later. So in this case, substantive enactment, that idea is satisfied in the form of the announcement. Okay, so it stands and it qualifies it to be, so the announcement qualifies it to be substantive enactment. So based on that question again, what is the tax rate that is substantively enacted by our current year end? And so our current year end is 28 Feb 2022. What rate or what substantive enactment rate was announced? It was the 27%. So all this first question asks is, do I have options in terms of tax rates? So historically, we've always had the 28% available. Now we've got an announcement that brings in a new potential tax rate, which is the 27%. So back to the methodology, what tax rate is substantively enacted by year end? In our case, it's the 27%. Second question, what tax rate applies when that specific current tax liability is to be paid? So when we actually need to make payment to the receiver of revenue, what is the tax rate that we have to settle that based on? And so our second question asks, when do we need to make payments? And so we are basically going to have to make payment for the 28 February 2022 year end. So what does the receiver of revenue expect? What is legally effective as the tax rate? Legally effective, it's only the 28%. So the receiver of revenue is only going to receive the amount based on the 28%, not the 27%. So the first question, once again, just asks, do I have options? Second question builds on that and says, okay, then what is the rate that's actually expected to be used when settling? So what is my date of settlement? It's going to be 28 Feb 2022. By law, what tax rate was actually in effect? And technically, only the 28% is effective based on law. And therefore, we use the 28% to measure our tax liability. So we'll take the 10,000 Rand for our February 2022 year end, and we'll multiply it by 28% because by law, the receiver of revenue cannot enforce the 27%. How come? Because it is only effective for year ends 31 March 2023 or later. Where are we sitting in our timeline? We're sitting at 28 Feb 2022. And so they cannot enforce the 27% because by law, the 28% is our go-to rate. So we'll use the 28% to measure that 10,000 Rand by. Then we fast forward the clock 1 year later. So now we're sitting at 28 February 2023. And so using those two questions again, first question, what rates are substantively enacted by year end? And so we know in a previous year, there was an announcement introducing a second option. So question 1, the rate that's substantively enacted because of the announcement was the 27%. And historically, we've always had the 28%. So we basically have options. That's what the first question is implying. Question 2, when I actually have to pay, what's the rate that the receiver of revenue can actually enforce or impose on me by law? So by law, has the 27% actually come into effect based on my year end? No, the 27% only comes into effect for year ends from 31 March 2023 or later. If I'm sitting at 28 Feb 2023, then this new tax rate has not yet come into effect and it cannot be imposed upon me by law. So question 1, I've got an option between 27 or 28. Question 2 asks, when I actually have to pay my current tax, what is the rate that is enforceable, that I'm obligated to use, that the receiver of revenue can hold against me? And so by law, because I'm a month before the new tax rate actually kicks in, I am going to use the 28% still. Then we fast forward the clock one more year, 28 Feb 2024, and we run through the same methodology. Question 1, what tax rate is substantively enacted by year end? A couple of years ago, we had the announcement that introduced an option of a 27% and a 28%. So 28% historically, and then the announcement, the substantive enactment introduces the alternative, which is 27%. Our question 2, when I actually have to make the payment, where I physically have to settle and pay to the receiver of revenue my current tax liability, what is the legally enforceable tax rate that's applicable at that point in time? So if we look at our timeline, the new tax rate, 27% by law, comes into effect for year ends of 31 March 2023 or later. In our timeline, we're sitting at 28 Feb 2024. So we're after that technically effective date. And that will mean that for 28 Feb 2024 year ends, that's when my 27% is going to then start to be used. So to summarize, 28 Feb 2022, the tax rate that we're going to use at that point in time would have been my 28%. 2023, if it's a Feb 2023 year end, still 28%. And then only from 2024 will that 27% kick in. Again, if it's a Feb year end. So the only thing left to discuss is the provisional tax treatment and how we are to think about that. So when it comes to provisional tax, we have to bear in mind that provisional tax is not a tax in and of itself. It's purely a financing mechanism. So it helps you in terms of managing the load of a full year's worth of current tax liabilities. And so basically splits that payment into two parts so that you can manage the load, as opposed to getting to the end of the year and you have this, you're slapped with this fat current tax liability. And so splitting it into two parts, that's the purpose of provisional tax, just to make it more manageable. So in this context, how would provisional tax play out? Now, effectively, because we have to pay part the way through, you might be in the mindset that you are to use, let's say, the old rate. And then if the other payment happens to be after the date of effectiveness being 31 March 2023 or later year ends, that you would then need to use a different rate for the second payment. Effectively, we need to kind of think ahead. When is my current tax liability actually due? What is the year end point where it then actually becomes liable? And that is the go-to date that you need to utilize when thinking about your provisional tax payments, be it the first one or the second one. So if we had to use our specific example here, 28 Feb 2022, let's say that is the year end and we're paying provisional tax towards that year end. We need to ask ourselves, well, what rate are we going to use for the initial payments and then for the second payments? And so it's going to come down to the 28 Feb 2022 year end, or what is the legally obligating rate that we are to use to then make payment over to the receiver of revenue at that date. And so at 28 Feb 2022, though we have the substantively enacted rate, which is the announcement that triggered the 27%, that essentially based on our methodology gives us options. So we've got the 27, that's a possibility, we've got the 28, but when I actually need to make payments and make good on my payment to the receiver of revenue at the 28th February 2022, what is the legally obligating rate or legally obligated rate at that point in time? It's the 28%. So my provisional tax that would have been applicable for that financial period. So the first one and the second one would be based on the 28%. If we had to fast forward the clock 1 year and we say our next year end is 28 Feb 2023, what would the tax rate need to be in terms of the first and the second provisional payments? So again, we have to ask ourselves, when I need to make good on my payment to the receiver of revenue for that entire year's current tax liability being 28 Feb 2023, what is the legally enforceable rate that's applicable? So yes, substantive enactment is applicable in that I've got the 27% as an option, but I also have the original rate, which is a 28. But what would I legally be expected to pay, or what is legally enforceable against me at 28 Feb 2023? That would still only be the 28%. So my provisional tax payment is going to be based on the 28%, both for the first and the second payment. If we fast forward the clock another year to 28 Feb 2024, we then ask ourselves once again, is there a substantively enacted rate that's available, giving me options? And what is the legally enforceable rate when I actually need to make good on the payment to the receiver of revenue? And so in this case, do we have a substantively enacted rate? No, we've got an actually enacted rate, because where are we in the timeline? We are sitting at 28 Feb 2024. That means that the 27% has become legally effective, because that came into effect formally from 31 March 2023 and later year ends. And so we're sitting at 28 Feb 2024. So that's after that date, the effective date. That means that we don't have substantively inactive rate. We've got an actually enacted rate, meaning we are required to use 27%. So the first provisional payment, as well as the second provisional payment, is going to be based on the rate that is expected to be utilized or legally enforceable at the date I actually need to pay my current tax liability, which is 28 Feb 2024. So for both the first and the second provisional payment, we'll use the 27%. Now, what happens if we have a situation where we have, for example, a client that has a 30 June year end? And so let's try and visualize that. It's just right over here. So we've got a client that's got a 30 June 2023 year end. How are we to determine what rate to use for the provisional tax payment? So again, using our methodology, at the date 30 June 2023, do I have a substantively enacted rate? So where are we in the timeline? 30 June 2023 is after the effective date of the new tax rate, which was 31 March 2023. That means we don't have a substantively enacted tax rate. We have an actually enacted tax rate. And with that said, we are going to base our calculation or first and our second provisional payment on 27%, because that's the legally enforceable rate when I need to make good on my payment of my current tax liability, which is set for 30 June 2023. So my first one, even though it's going to be before the effective date, being 31 March 2023, or year ends of 31 March 2023, I need to ask myself, well, what am I paying towards? I'm paying towards the eventual liability, which becomes due from 30 June 2023. And so my first provisional payment is going to be to contribute towards that liability. And so the rate then that I'm going to use is the rate that's applicable when it's actually due. So my first provisional payment is going to be based on the 27%, as well as the second provisional payment. So the thinking that needs to be borne in mind is when I actually need to make good on my payment to the receiver of revenue of my current tax liability, what is the rate that is legally enforceable? And so at 30 June, it's the 27%. Therefore, both my first provisional and my second provisional payments are going to be based thereon, because I'm going to have to eventually pay that current tax liability using the 27%. So my provisional tax, my first payment is going to be based on the 27%. As well as the second one. So all in all, I ask myself, what tax rate is substantively enacted? That basically means, do I have options in terms of alternative rates? Second question, when I actually need to settle it, what is the legally enforceable tax rate applicable at that point in time, at that given year end? And so in our case, the 27% only becomes legally enforceable from 31 March 2023. So if I have a tax year that precedes that, so is before that, then I'll stick to the 28%. If I have a tax year that ends on 31 March 2023 or later, I have to then utilize the 27%. Let's move on to deferred tax. So how do we get to the point where we need to start asking the question about what tax rate to potentially use? Here we have a bit of a breakdown of the deferred tax calculation. So you always start out with the carrying amount. So the carrying amount, CA, stands for carrying amount of your assets and liabilities from your balance sheet. So we'll take our trial balance and we'll list all our assets and liabilities. That's typically where we start a deferred tax calculation. Then we have to subtract from that our tax base. And so our tax base is going to be based on the manner of recovery. So either through use or sale or both. as is expected by management. And then we'll have, as a net result, we'll have our temporary difference. And so from our temporary difference, we then need to consider multiplying it by an appropriate tax rate. And so that tax rate will then lead us to the deferred tax asset or liability. So please bear in mind, when it comes to your deferred tax calculation, you have to calculate the eventual deferred tax asset or liability by going one item at a time. So you'll start with motor vehicles, for example. Then you'll go on to inventory. Then you'll look at trade receivables. Then you'll go on to payables or creditors. Then you'll go into land and buildings. And so we go one at a time. So when you are trying to measure your deferred tax, your temporary difference so that you can turn it into either a deferred tax asset or a deferred tax liability, you need to be going one at a time. Okay, so there is no blanket approach when it comes to the tax rate. We have to go one at a time. Okay, so we'll understand that a little bit more now. So the references for measurement of deferred tax come from two places. So if it's full IFRS, it's IAS 12, paragraph 47. If it's IFRS for SMEs, it's section 29, paragraph 27. And so what does it state? It says, when it comes to my deferred tax assets and liabilities, they shall be measured at or based on or considering two aspects. First of all, the tax rate. So measure it at the tax rate that is expected to apply to the period when the asset is realized or the liability is settled. With that, we need to then base it on tax rates or otherwise tax laws that have been enacted or substantively enacted by the end of the reporting period. Okay, so two things to bear in mind. How do I measure my deferred tax asset or liability? So for each individual item, so my motor vehicles, then land and buildings, then whatever else, I need to use the tax rate that's expected to apply when that motor vehicle, when those land and buildings, when the inventory, whatever it is, when it's expected to go through my future tax calculations. So this is what we mean here at the back end where it says when the asset is realized or liability settled, meaning when is it actually going to reverse and go into my tax calc? And so we then base it on the tax rates that have been enacted or substantively enacted by the end of the current reporting period. So to turn that into a bit of a methodology, we've got two questions that we need to ask. The first question is as follows. What tax rate is substantively enacted by year end? So similar question to when we're dealing with current tax. And then secondly, what tax rate applies when that deferred tax liability or asset is to be settled or realized for the underlying item? Meaning, when it eventually goes through a future tax calculation, what is the tax rate that's going to apply in that future year? In other words, the second question implies that there's going to be it might be different. How we answer this question may be different dependent on the particular asset that I'm looking at or the liability I'm looking at in my big deferred tax calculation. So motor vehicles' answer to the second question might be different to inventories. And so this is why we have to ensure that we go one at a time. So let's help you visualize using an example. So similarly, we have an entity that operates in a jurisdiction where the tax rate has changed from 28 to 27% as announced on the 23rd of Feb 2022. And the tax rate will apply for year ends or year begins of 1 April 2022 or later, which translates to 31 March 2023 year ends or later. At a given year end, so 28 Feb 2022, the entity has an asset of 6,800 Rand for interest receivable that will be taxed when cash is received. So we've got an asset of 6,800 Rand. It's for interest receivable that will be taxed when cash is received. Okay, so don't think in terms of SA tax law, just think within the vacuum of this particular example. So we've got an asset, it's an interest receivable item, and the temporary difference for this item is 6,800. So basically what it's saying is I will only be including this in my tax calculation in a future period when I actually receive the cash. So it's similar to an interest accrual, if you will. So in this particular case, for the sake of the example, we're saying that we have a temporary difference of 6,800. I'm only going to be allowed to put this through as gross income when the cash is actually received. Okay. So I've got this temporary difference and I now need to measure it. I need to turn this into a deferred tax liability. Why is this a deferred tax liability? Because when I actually receive the cash, then I'm going to put it through my gross income. That means it's going to drive up my taxable income and I'm going to have to multiply it by a particular tax rate. So in the future, when it goes through a future tax calculation upon payment, so it's in that year that it will go through that future tax calculation, only at that point will I actually then include it in my tax calculation. So in other words, when it goes through in that future period, it's going to increase my taxable income. Okay, because it's going to be gross income in a future period. And because it's going to increase my taxable income in future, it's going to lead to a deferred tax liability, meaning in future, I'm going to have to pay a bit more tax. So to the value of 6,800 multiplied by the appropriate tax rate. So our requirement is what tax rate applies to deferred tax at 28 February 2022, 23, and 24. So let's try and understand. Okay, so using that timeline again, let's quickly set up. So we've got 23 Feb 2022, that was the announcement. And the announcement we know serves as substantive enactment. In other words, we don't have to wait for it to physically be written into law for this announcement to actually have validity. Okay, so this is just as good as it being brought into law. What is going to be brought into law? The fact that on 31 March 2023 or later, for those tax year ends, 27 is going to be the applicable rate. Okay, so the announcement is just forewarning you about the future tax change, but we don't have to actually wait for it to be written into law for us to take the announcement seriously. Okay, at the end of the day, announcement or action enactment points to the future and says only in the future from 31 March 2023 or later, 27% applies. Okay. The next part of our timeline is where is our first year end? 28 Feb 2022. Then we have the tax rate changing. So we can go 1 April 2022. So year end. And tax begin change. And then we've got our next year end, which is 28 Feb 2023. And then we have our 31 March 2023. That will be when the tax end change happens. Okay, tax end change in rates. Okay, so in this case, we've got a temporary difference of 6,800, which is going to lead to future deferred tax liability. Okay, it's going to increase my taxable income in future. Now I need to decide, how am I to measure this? Am I going to use 28 or 27%? And so following that methodology, question 1, what tax rate is substantively enacted by year end? What does that translate to? So question 1 asks, do I have options? So looking at our first year end, which is 28 February 2022, when did the announcement happen? The announcement happened in that same year, 23 Feb 2022. So that falls within my first year end, which is 28 Feb 2022. So by the end of that year, 28 Feb 2022, what tax rate is substantively enacted? 27%. And we know that on the other hand, we also have the available 28%. So we've got the historical rate and we've also got the substantively enacted through the announcement rate at my 28 Feb 2022 year end. The second question based on our methodology is, what is the tax rate that's going to be applicable when the deferred tax liability or asset is to be settled or realized for the particular item that we are looking at? So in this case, our interest receivable item, that's only going to be taxable income in a future period. So what tax rate applies when the deferred tax liability or asset is to be settled or realized? So in this case, this interest receivable is going to lead to a deferred tax liability. And so we ask ourselves, when is this deferred tax liability going to be settled for that particular item? Simply put, that means in what is the tax rate that applies in the year that we expect this item to go through a future tax calculation? So if we go forward to our example, it's going to rely on judgment. Okay, so we've got this 6,800 Rand interest receivable. We need to go and ask ourselves, in what future period am I expecting this amount to then be received in cash? Because as soon as it's received in cash, it's going to go through a future tax calculation. Now, when is that period? So if I'm standing at my current year end, which is 28 Feb 2022, I need to ask myself, when is it going to go through a future tax calculation? So if I've decided that it's going to go through the 28 Feb 2023 tax calc, it's going to go through there. In other words, it's going to be gross income in that future tax period. I then, based on the second question in the methodology, need to ask, what is the tax rate that is applicable in that future period? So if we consider our timeline, when does the 27% become effective? The 27% becomes effective for year ends of 31 March 2023 or later. If I expect that this item is going to realize or go through a future tax calculation in the 28 Feb 2023 year end, is that before the 31 March 2023 or is it after? So in other words, is it before that tax rate comes into effect or is it after? So in this case, it's before. So the 6/8 is going to go through a future tax calculation. When do I expect that to be? I expect it to be in 28 Feb 2023 year end. When does the new tax rate come into effect? A month later. So this is before the new tax rate comes into effect. And in that case, based on question 2, I'm going to measure my my temporary difference. I'm going to measure it, so multiply it in this case by the 28%. Because we are required to look to the future and ask ourselves, what is the rate that's going to be in effect when I think that item is going to go through a future tax calc? Let's move it further. Let's say our anticipation is that, so let's say we're still standing at the 28 February 2022 year end. And for this receivable, this interest receivable, our expectation that is that it's only going to go through in the 28 Feb 2024 year end tax calculation. Okay, so it's not going to go through next year, it's going to go through 2 years down the line. Following the methodology, I ask myself question 1 is, what is the rate that's substantively enacted? The rate that's substantively enacted at our current year end, 28 Feb 2022, is the 27%, meaning I've got options. The second question helps us determine which is the appropriate rate from those two options. Second question is, when I expect this to go through a future tax calculation, what is the tax rate that's going to be legally enforceable in that year when I actually have to settle the current tax liability in that future period? And so if I take the position that 28 Feb 2024 is when it's going to go through a future tax calculation, I need to ask myself, well, what is the tax rate that's applicable in that year? And so again, we go and ask ourselves, when does the new tax rate come into effect? It's 31 March 2023 or later tax years. If I'm sitting at 28 Feb 2024, is that before or after 31 March 2023? It's after. And because it's after, that will mean that I'll take the temporary difference and I'll multiply it by the 27%. Because when I expect it to go through that future tax calculation, what is the legally enforceable tax rate at that point in time, 28 Feb 2024? It's the 27%. Do you see that? Okay. So this is why I say when you go through your deferred tax calculation, you have to go line for line for line and ask yourself, when do I expect this item to realize or to fully go through my future tax calculations? And so that is going to be a matter of your judgment. So one person's judgment may differ from the next person. So important for us, therefore, to ask the question, when do we expect? So can you see, we were still focusing on the 28 Feb 2022 deferred tax calculation, but because deferred tax looks to the future, and based on that methodology, the question 1 and question 2, in the first place, I expected it to only go through in the next tax calc, and that's before the tax rate becomes legally enforceable. And so I'll stick to the old rates. If my second expectation is that it's only going to go through in 2024's tax calculation or tax year end, what's the tax rate that's legally enforceable then? It will be the new 27, and I apply it to that particular item. The next item might have a different take. So for example, motor vehicles, I might realize that in 5 years' time. In other words, it will only go through my tax calculation in 5 years' time, or fully go through in 5 years' time. And so what is the tax rate that's going to be applicable in 5 years' time? And so that's the train of thinking that we need to have when we're trying to determine our tax calculation for deferred tax. Okay. Let's look at it from a second example or second perspective. Let's say our current year end now is 28 Feb 2023. Okay, so we're sitting at 28 Feb 2023. This is my current reporting date. I've got the same item on hand at that year end point, and I'm trying to determine what to measure it by. What is the most appropriate percent to utilize? I therefore need to ask myself, based on the methodology, what is the rate that is substantively enacted at my current year end, my current reporting period, 28 Feb 2023? And in this case, we know that a year ago, or 2 years ago, in fact, there was the announcement that there's the potential for a 27% that's going to come in the future. So basically, question 1's answer is it's the 27%, and that means I've got an option. I need to decide between 27 or 28. Next question I need to ask is, when this item is going to go through a future tax calculation. What's the tax rate that's going to be applicable in that future period? So if I'm currently sitting at 28 Feb 2023, I've got this temporary difference for this interest receivable. It's going to lead to future increased taxable income, meaning it's going to eventually become a deferred tax. It's going to be a deferred tax liability for me now. I then need to ask myself, based on the second question, what's the tax rate that's going to be applicable in that future period? So if my anticipation is that it's going to go through the 2024 year-end tax calculation. So in other words, 28 Feb 2024, that's when I think it's going to go through. I'm therefore going to need to ask myself, what is the tax rate that is applicable, legally enforceable at that date when I'm calculating that current tax in that future period, when I think this item that I have now is going to go through in a future current tax period. And so 28 Feb 2024, once again, is after the imposition of the new tax rate. And because that's the case, I'm therefore going to multiply that interest receivable when I'm calculating my deferred tax at 28 Feb 2023, I'm going to take that particular item and multiply it by the 27%. Okay, so this is the train of thinking that we need to bear in mind. If we fast forward the clock one more time to 28 Feb 2024, when I'm doing my calculation for my deferred tax at 28 Feb 2024, I need to ask myself what tax rate is available. That's the first question. And so we know that the tax rate of 27% came into effect from 31 March of 2023. So if I'm sitting at 28 Feb 2024, that's after that 27% has come into effect. And so at that date, do I have a substantively enacted tax rate or do I have an actually enacted tax rate? In this case, I have an actually enacted tax rate because by law, it is now enforceable. And therefore, I don't need to focus on substantive enactment. I focus on actual enactment, meaning at that point in time, the only tax rates I have available is the 27%. So that means that every item that I'm trying to measure either a deferred tax asset or a liability for, I'm going to then strictly use the 27%. In other words, remember the second question asks, in the future period, when it actually goes through a future current tax calc, what is the applicable tax rate at that future point in time? And so I only have one tax rate, and so that's the only tax rate that I'm going to be able to use for any future period. And so that's the train of thinking that we need to have in mind. Now let's think about a slightly different example to the one that we're dealing with here. So effectively, we've got one item, and we've taken a look at the train of thinking that needs to be borne in mind when it comes to your deferred tax calculation. Let's try and flip it up and look at a slightly different example where we have an asset that leads to, for example, a temporary difference, and the temporary difference is going to realize, or that asset and its temporary difference is going to realize over several periods. When we say realize, we mean when is it going to go through the future tax calculations? And so we could have a situation where it goes through multiple future tax periods, whereas the example that we're looking at on this particular slide is where there's a single period where it goes through the current tax calculation in future. So just to give us some space, let's maybe go here, one slide back, just so we have some space to write. Okay, so let's use a bit of an example. So let's say we've got a motor vehicle, and the motor vehicle cost us 100,000 Rand initially. And for accounting purposes, we're going to write it off over 5 years, meaning it's a 20,000 Rand per year depreciation for accounting. And then from a tax perspective, we will get the wear and tear allowances over 4 years, meaning it's 25,000 Rand wear and tear, tax deductions, tax depreciation. So doing our deferred tax calculation, we've got a carrying amount for accounting purposes, we've got our tax base, we've got a temporary difference, and we've got a deferred tax liability or asset as is applicable. So in this case, what is our carrying amount? Let's assume we're 1 year down the line. Our carrying amount, therefore, for accounting purposes is going to be the 80,000 Rand. Our tax base is going to be what the remaining or the future tax allowances are. And so we received the first one of 4. That means that 3 to go. So that makes it a 75,000 Rand tax base. That leads us to a temporary difference of 5,000 Rand. So our impulse is to take the 5,000 Rand and multiply it by the tax rate. However, because we're dealing with a situation where we've got some substantive enactment, it basically puts us in a position where our tax rates in the future may be different for an asset that realizes over multiple future periods. So let's maybe use actual figures. Let's say this carrying amount that we've got here is at 28 February 2022. Okay, so 28 Feb 2022, and that's our accounting carrying amount. So that basically means that we now need to calculate deferred tax for the remaining years. So for accounting, there are 4 more years. For tax, there are 3 more years. And so let's run those future year periods. So 28 Feb 2023, we'll keep over here. Then 24, then 25, and then 26. So let's look at accounting versus tax, the differences. So in the first future year being 2023, the amount that's going to go through a current tax calc in the year 2023 is going to be 20,000 Rand. Tax purposes, it's going to be 25,000 Rand. And so the net of the two is going to be 5,000 more so a higher deduction for tax purposes. Then in the next year, another 20,000 and 25 net 5. Then in the year that follows, another 20, and for tax purposes, 25, and that's a net 5. And then in our final year, it's going to be 20 for accounting purposes, but tax, it'll be 0. And that leads us to a net 20,000. So effectively, I'm going to have higher tax deductions. I'm going to have higher taxable income because I've got less, or in this case, no tax deductions in that final year for this particular motor vehicle asset. So when we calculate that, when we add up all of those years, it will be 15 minus 20. That's a minus 5,000. And so that reconciles us back to the temporary difference of 5,000 Rand. Now, how are we to measure this? Can I then just go and take this 5,000 Rand and use a future year percentage? Or is it a little bit more nuanced than this? So technically, we don't have specific guidance in terms of this type of scenario, but what we do have is we need to bear in mind this methodology. So our first question again is, what tax rate is substantively enacted by a year end? And question 2, what tax rate applies when the deferred tax liability or asset is to be settled or realized for the underlying item? So in this case, our deferred tax liability, because effectively this is going to be a liability, it's going to lead to higher taxable income in future. And for that, we then need to ask ourselves, when is it going to be realized? When is it going to go through my future tax calcs? And so as we can see, it's going to go through in multiple periods. So it puts us in the precarious position of what tax rate is then most applicable. So dealing with the year 2023, what is the tax rate that we need to use? So again, using this methodology, what rate is substantively enacted by 28 Feb 2023? The 27% is substantively enacted. So we have options, either the 27 or the 28. And then in terms of our second question, we ask ourselves what tax rate applies when the deferred tax liability asset is to be settled or realized in relation to the underlying item. So in this case, at this point in time, what is the tax rate that's going to be applicable when it partially realizes? So in other words, only 25,000 is going to go through a tax calc. So at this year end, we had the option between 27 and 28. What is legally enforceable when we do our 28 Feb 2023 tax calculation? It's going to be the 28%, so the old rate. So maybe to make this a little bit easier, so fine, we've reconciled all of those temporary differences. And so the tax rate we're going to use in that year is going to be 28%. A year later, what is the legally enforceable tax rate when I need to settle my 28 Feb 2024 current tax liability? It's going to be the 27% because it's no longer substantively enacted. It is now actually enacted because it's a year end that's after 31 March 2023, which is the effective date. Then in terms of our next year, what is the go-to rate? It's going to be 27 because we only have one at that point in time. And then in that last year, we also have the 27. Nothing will go through my tax calc, but that would be the go-to rate to use. So when we run all of these numbers and we add it up, that will give us what our deferred tax liability is going to be. So using a calculator quickly. So we've got our 25 times 28. Sorry, our 5 times our 28. That's 1,4. Then we've got our 5 times 27. That's 135. And then for the next year again, 135. And then in that final year, 54 the other way. So when we add up all those numbers, so 54 minus the 14 minus the 135 minus the 135 gives us 13. So our deferred tax liability then is 0.13. And so we can go pop that in over here. And that is our deferred tax liability. So technically, this is the correct way to do it because you need to split or apportion it. Now, of course, this becomes a little bit onerous as soon as we have multiple motor vehicles, multiple buildings, multiple office equipment items that we bought at all kinds of different times. So it may become quite onerous to do this. So do we have relief? Do we have a shortcut? Technically, we don't. Okay, because the standards, so IS 12 as well as IFRS for SME Section 29, don't actually give us a way out. So technically, this is what we are supposed to do, but admittedly, it is onerous. And so as a suggestion, and please note, you have to decide and justify if this is what you're going to use. Okay, so this is a suggestion, but you have to make the final call. It's going to hinge on your judgment ultimately. And so as a shortcut, what we could do then, instead of splitting out our motor vehicle or whatever the asset is into its future periods, trying to discern what is going to go through at what rate, as a workaround, as a shortcut, we take the temporary difference and we multiply it by the rate that is applicable when the asset fully realizes through future tax calculations. So in other words, when it goes through in its final year, what is the applicable tax rate? So when it goes through my tax calc in its final year, or when the deferred tax liability is going to realize finally, so ultimately, meaning all future amounts that are going to go through future tax calcs or otherwise accounting profit calcs, when does that stop? In other words, when is it fully realized? When is it fully going to go through future accounting / current tax calculations? And so that in this case would be 2026 or the last year. And what is the tax rate that's applicable in that year? It's going to be the 27%. And so if we use that as a shortcut and we had to run the numbers, it's 135. So as you can see, technically we are not going to be 100% correct, but as a workaround, this is a suggestion that you can bear in mind. Remember, this is based on your judgment. So you have to justify this. You need to include your justification because technically this is not correct. Admittedly, it does become onerous as soon as we have multiple assets that from a timing perspective are being bought and utilized at various points in time and over various periods of time. So the last thing that I want to discuss with you is disclosure and what goes into the financial statements, in other words. So just something. So this is not meant to be a fully elaborate sort of explanation in terms of our financial statements and what's to go into it, but just high level. So generally we have our current tax payable. So here at the top, we've got our balance sheet, and then we've got our income statement. And so in terms of our balance sheet, where do we see tax be applicable or show up? We'll see it in our current liabilities for the current tax payable. Then we'll also have our non-current liabilities, which will typically be my deferred tax liability. And then in my income statement, where do I see the impact of current tax or deferred tax? I see it all in the income tax expense line item, which is the second last line item in my income statement. So where do I specifically need to bring in a mention of the fact that there is a tax rate change and that substantive enactment has taken place in my current period? So here we just have an excerpt of the accounting policy. So first of all, we've got what is the accounting framework we're using. So this is just an example. And then within our accounting policy notes, we have a note for income tax, so an accounting policy note for income tax. And so it's in this particular note where we should bring in reference to the concept of substantive enactment. So remember, in your accounting policy note, you're basically just bringing in extracts from the accounting framework. So from those paragraphs that we had mentioned or included a little bit earlier, bring that into the accounting policy note for income tax, because in this particular year and in future years, we'll be between the substantively enacted tax rate and the historical one, the previous one. So for the current period and the next period, so our 2023 year ends, our 2024 year ends, it's important then for us to help the user by bringing in those references to those paragraphs here in the accounting policy note for income tax. So please make sure you bring it in over here. Then we move into the income tax expense note. Okay, so that was the accounting policy side of things. What about the actual note that supports the income tax expense line item in the income statement? So the second last line item, we typically break it up into our major components. So what portion of the income tax expense pertained to current tax? So based on my current tax calculation, and what portion of it pertained to the movement tax year on year? And so that basically is what comprises my income tax expense line item. And then what is it that we need to bring in dealing with substantive enactment and a potential tax rate change? We need to bring into the narrative, so the paragraph here at the bottom, the fact that there is a substantively enacted tax rate. So we must make sure that we bring in reference to that and what the new tax rate is going to be. Okay, so it would be helpful for you to explain substantive enactment to your users and then make reference to what the new tax rate is and when it comes into effect and if it actually affected you in your current period and how it affected you. Okay, so it affected current tax as follows and deferred tax in a different way. And so we go and we set that out to help the user. Now, what we shouldn't forget is when it comes to my tax rate reconciliation note. So remember, in your income tax expense note, you've got the top part, which sets out the figures, the amount that makes up your income tax expense that appears on the income statement, that line item. And then with that, so in that same note, we've got the tax rate reconciliation. So please bear in mind that when you are preparing your tax rate reconciliation, that you are using the appropriate tax rate for your current tax calculation. So if we're dealing with the 28 Feb 2023 year end, what is the tax rate that we're going to use based on our conversation from the example a little bit earlier? So for current tax, in this case, we are going to use the 28% still. Why? Because by law, when I need to settle the current tax liability, what is the effective tax rate, the legally enforceable tax rate? It's still only the 28%. It's only from a month later, which is 31 March 2023 year end or later, that the 27% is what I'm going to use for measuring my current tax calculation. Okay. So please make sure we're using the right tax rate. And then, of course, if you are then doing your tax rate reconciliation here at the bottom, just making sure that you're using the right percentages. So ladies and gents, that's pretty much it for our conversation for today. If you have asked questions, I will be happy to sit with you now and work through. If you have any more, please feel free to use the Q&A block or box, or otherwise use the chat window to send through questions. I'm happy to help. If you have questions going forward, you are free to reach out. So we've got some contact details here on the screen at the bottom, so you can give me a ring. Otherwise, send me an email. I'd love to be able to chat to you if you have any questions. Happy to help. So do feel free to reach out next year or the year thereafter, or whenever it is you're trying to do these calculations or just trying to make sense of it. Let's see if we can try and assist. Please visit us on our social sites and give us your thoughts and your feedback on how you found the session. I do hope we'll catch you on a future session somewhere along the lines. But if not, I bid you farewell as you go into the festive break. Take care of yourself. May the Lord Jesus Christ go with you and may he bless you and keep you. Till we speak again, thank you so much. From Probita Training, goodbye.